First things first, let's start talking about the mindset. Investing isn't about getting rich quick. It's a long-term game focused on building wealth steadily over time. Think of it as planting a seed today that will grow into a mighty tree in the future. Now, let's define your why. What are your financial goals? Are you saving for retirement, a down payment on a house, your children's education, or simply to grow your wealth? Having clear goals will shape your investment strategy and help you stay motivated. Be specific. Instead of saving for retirement, think I want to have X dollars by age Y to retire comfortably. You should also need to understand your financial landscape. For example, income and expenses. Take a close look at how much money you are earning and where it's going. Tracking your expenses will help you identify areas where you can save more, freeing up capital for investment. Debt. High interest debt, like credit card debt, can significantly hinder your investment growth. Prioritize paying down such debts before aggressively investing. Emergency fund. This is simply non-negotiable. You need a readily accessible emergency fund covering 3 to 6 months of living expenses. This acts as an important safety net, preventing you from having to sell your investments prematurely during unexpected situations. The world of investing can seem complex, but let's break down some common options. Stocks, also known as equities, represent ownership in a company. They offer the potential for high growth, but also come with higher volatility, i.e. price fluctuations. Second, bonds, which are also known as fixed income. They represent loans that you make to governments or corporations. They are generally considered less risky than stocks, but typically offer lower returns. Third, mutual funds. They are pools of money invested in a diversified portfolio of stocks, bonds, or other assets, managed by a professional fund manager. While they offer instant diversification, they usually charge a small fee for managing such a diversified portfolio. Fourth, exchange traded funds, also known as ETFs. They are similar to mutual funds but trade on stock exchanges like individual stocks. They often have lower expense ratios than mutual funds. Last but not least, real estate. Investing in physical property can provide rental income and potential appreciation in value. It requires significant capital and can be less liquid. For beginners, I recommend mutual funds and ETFs, particularly low-cost index funds that track broad market indexes like the S&P 500 are often recommended due to their diversification and ease of access. How comfortable are you with the possibility of losing money in the short term for the potential of higher returns in the long term? Your risk tolerance will significantly influence your investment choices. Are you conservative? You prefer low risk and are comfortable with potentially lower returns? If so, you might lean towards bonds and more stable stocks. Another risk tolerance would be moderate. You're willing to take on some risks for potentially higher returns, balancing your portfolio with a mix of stocks and bonds. You could also be aggressive. You're comfortable with higher risk for the potential of significant growth, allocating a larger portion of your portfolio to stocks. Regardless, it's always important to diversify your portfolio regardless of your risk tolerance to prevent your investments from fluctuating a lot when when certain sections of the economy take a hit. There is no right or wrong answer for risk tolerance. It's about what aligns with your comfort level and time horizon. To start investing, you will need to open an investment account. Here are some common options. Brokerage accounts, offered by firms that allow you to buy and sell a wide range of instruments and investments, including stocks, bonds, ETFs, and mutual funds. Research different brokers based on fees, platform usability, research tools, and customer support. Popular options include online brokers. Another option is retirement accounts. These offer tax advantages and are specifically designed for retirement savings. Examples include 401k, RAS, individual retirement accounts, and in Singapore, CPF investment scheme, CPFIS accounts. Understand the tax implications and contribution limits of these accounts. The process of opening an account usually involves providing personal information, identification, and funding the account. Now for the exciting part, choosing your investments. Diversification is something so important that I can't stress enough. Don't put all your eggs in one basket. Spread your investments across different assets classes, i.e. stocks and bonds, sectors like technology, healthcare, whatnot, and also geographies to reduce risk. Another strategy would be dollar cost averaging, which involves investing a fixed amount of money at regular intervals regardless of market fluctuations. It helps to average out your purchase price and reduces the risk of investing a large sum right before a market downturn. Always start small and be consistent. You don't need a huge amount of money to begin. Start with what you can comfortably afford and aim to invest regularly. Consistency is key to long-term growth. For beginners, consider starting with low-cost index ETFs that track broad market indexes. This provides instant diversification and typically has lower fees. Investing is not a set it and forget it activity. It's always important to monitor your portfolio, regularly review your investments weekly, monthly, and see how they are performing against your goals, and also rebalance periodically. As over time, your asset allocation may drift due to varying performance. Rebalancing involves selling some assets and buying certain others to bring your portfolio assets back to your target allocation. This helps to manage risk. Always stay informed. Keep learning about personal finance and the markets, be it reputable finance news sources, books, and articles. Understand the basics of economics and market trends. All in all, starting to invest is a journey, not a race. Be patient, stay disciplined, and focus on the long term. Don't be afraid to seek advice from qualified financial professionals if you need personalized guidance. You got this.